In 2012, Greece's government debt-to-GDP ratio reached 166%. The country required an international bailout. Bond markets stopped lending to it. The economy shrank by a quarter. Japan's government debt-to-GDP ratio today is approximately 235%, the highest of any major advanced economy in the world. By every standard applied to Greece, Japan should have collapsed 30 years ago. It has not. Greece's debt crisis happened because Greece borrowed heavily from international investors in a currency, the euro, it could not issue itself. When those investors lost confidence, they stopped lending. Greece had no mechanism to replace that funding on its own terms. Japan issues its debt in yen. Japan controls the yen, and roughly 90% of Japan's government debt is held domestically, by its own central bank, its own pension funds, its own banks. Foreign investors pulling out of Japanese bonds barely registers. The creditor is, in large part, Japan itself. Japanese government bonds also carry extremely low interest rates, which keeps the cost of servicing that large debt manageable. Here is the mechanism that makes Japan's gross debt figure large, but its actual situation more stable than it appears. Japan's government issues bonds. The Bank of Japan buys a large proportion of them, currently around 46% of all outstanding bonds. The government then pays interest on those bonds to the Bank of Japan. The Bank of Japan, as a central bank, remits its profits back to the government treasury. This is not a trick. It is the structural relationship between a sovereign government and its central bank, operating in a currency it issues. It is the same mechanism the Bank of England uses. The United States Federal Reserve uses it. What is unusual about Japan is the scale. Now the number that almost nobody discusses. The Japanese government holds substantial financial assets. Its public pension reserve fund invests in equities, domestic and foreign. By 2023, those reserves had grown to approximately 60% of GDP, even after decades of social security deficits, because the investments outperformed. Add other government financial holdings, and Japan's total public sector assets are approximately 134% of GDP. One common measure of Japan's consolidated public sector net liability, liabilities minus assets, is roughly 120% of GDP. Some comparable calculations place the United States at a broadly similar net level. The gross debt figure, 235%, is real. It measures a real quantity, but it omits the asset side of the balance sheet entirely. A household with a large mortgage and a large investment portfolio is not in the same position as a household with the same mortgage and no assets. The number that gets quoted is the mortgage. The portfolio is never mentioned. Japan's debt number is not a lie. It is an incomplete picture shown as if it were the whole picture. The mechanism that keeps Japan stable, a sovereign currency, domestic creditors, a central bank loop, and a substantial asset base, is not hidden. It is just not in the headline.